Hello, and thank you for joining us for another Investors Trust Company video. I'm Adam Morgan, and I'm joined today by Deeds Kienker. Today, we're going to talk about fixed income investing, and more specifically, what impact do rising interest rates have on bond market performance, and what can investors do about it? Now, as most of you already know, in the United States, long-term interest rates have been coming down steadily for about the last 40 years or so. But it might surprise you to learn that over that same time period, there were several shorter-term periods where interest rates actually rose. Deeds has analyzed bond market performance during those shorter periods of time, and today he's going to explain to us how his analysis is impacting our current fixed income strategy. But before we begin, and just as a refresher, why do changes in interest rates matter to bond investors? Most bonds pay a fixed rate of interest via a coupon payment. So as interest rates rise, that fixed coupon payment and ultimately the underlying bond become less valuable. Now, you can always hold that bond to maturity, and if that works for you, great. But in doing so, you're essentially accepting an income stream that isn't as large as it otherwise could be if you went out on the open market and bought a newly issued bond, for example. And because interest rates are near their all-time historic lows, this is something we want to get right. So with that as a backdrop, Deeds, what can history tell us about the bond market when interest rates are changing?
Yeah, sure thing, Adam. Firstly, let's talk about interest rates. As you mentioned, interest rates have been declining basically since the early 1980s. As a way to visualize this, let's take a look at rates just over the last 30 years. Our first chart here plots the interest rate of the 10-year U.S. Treasury beginning in 1991. As you can see, it's been in a clear downtrend for the entire 30-year period. However, as you mentioned, there have been many times when the 10-year yield rapidly increased over a relatively short period of time. More specifically, we highlight here 11 instances on this chart, as denoted by those red arrows and lines that you can see, when the 10-year yield jumped by more than 1% over time periods ranging anywhere from 3 to 18 months. And so as we sit here today, given that interest rates have started to move higher over the last several months, while at the same time remaining not too far off their historic lows, we think we could be in the midst of another rising rate period.
Okay, Deeds, well, let's assume for a moment that we're right. How should we be invested?
Great question. So historically, the best way for fixed income portfolios to be positioned as interest rates are rising is to have exposure to short duration and credit sensitive bonds. Now let's take a look at exactly what that means on the next slide and see how these types of fixed income securities that I just mentioned have performed in the past. So as you can see in the table here, we've listed 11 rising rate periods that I mentioned before, as well as the most recent period we're currently in, which began in August of last year. This is when the 10-year Treasury hit its all-time low of 0.52%, and it's been trending higher ever since, sitting currently just north of 1%. For each of these periods, we've included the total returns for the 10-year U.S. Treasury note, the Barclays Aggregate Index, as well as a select bucket of low duration and credit sensitive sectors, which we've got grouped together in the green box that you can see right there in the middle of the table. And we've also thrown in the S&P 500 index for a comparison of how equities have also performed over the same time frames. As you can see from this table, longer duration and government-related securities like the 10-year Treasury and the Barclays Aggregate Index usually produce negative returns when rates are rising. Conversely, lower duration and credit-sensitive bonds, like the ones I've selected in the box, have historically generated positive returns over these same time periods. So why is this? Well, it really comes down to two major factors. The first factor is duration, which is the measure of how sensitive a bond's price is to changes in interest rates. Low duration bonds are less sensitive to rising interest rates, so their prices tend to experience less downward pressure than longer duration bonds. Generally speaking, short duration bonds include those that are scheduled to mature anywhere within the next 3 to 5 years. These include short-term municipal bonds or short-term corporate bonds, for example. They also include securities like investment-grade floating rate notes or leveraged loans. These are securities that have variable coupon rates that move in the same direction as market interest rates. So interest rate risk is essentially removed from the equation when you're talking about these types of bonds. The second major factor is credit risk. Usually when interest rates move higher, this generally correlates with an improving economy. And when economic conditions are getting better, we tend to see a rise in corporate earnings, improving credit fundamentals, as well as a greater propensity for investors to take on risk. And this includes greater demand for fixed income securities that offer higher yields than you can get with traditional government bonds, but with a higher degree of risk. And much of this is credit risk, or the risk that a bond's issuer might default. This is what we mean when we talk about credit-sensitive bonds. These could be anything from municipal and investment-grade corporate bonds to much riskier types of fixed income securities like leveraged loans, high-yield corporate bonds, or international high-yield bonds. In a general sense, the increase in price that these types of bonds experience due to greater investor demand in rising rate periods has historically been enough to offset the negative impact from higher rates. So to tie this all together, we continue to be advocates for maintaining a diversified fixed income portfolio. Our multi-sector strategy, which includes allocations to both short duration and credit-sensitive bonds, as we just discussed, not only has several long-term benefits, but may also be the best approach if we are truly in the early stages of a rising rate environment.
Okay, great, Deeds. Thank you very much. I think the big takeaway here is that just like in our equity strategies, asset allocation within a bond portfolio plays a very important role in helping to balance downside risk with potential for return. Now, if you would like to discuss the asset allocation strategy being implemented in your portfolio, or if you'd just like to learn more about our investment process in general, please reach out to your wealth advisor or feel free to call me directly. Thank you very much. Be well.